margin accounts, and the $25,000 PDT trap. Here's what every new day trader needs to know. You open a margin account to day trade US stocks. You place 4 trades in a week, and suddenly your broker flags you, locks you out, and tells you that you need $25,000 in the account before you can place another day trade. That's the pattern day trader rule. It's been in place since 2001, and it catches more first-time day traders than any other regulation in the US market. Here's how a margin account actually works, what the PDT rule does, and the workarounds if you don't have $25,000 sitting in the account. Start with the basics. A margin account is a brokerage account that lets you trade with money borrowed from the broker. 2 things that does for you. It gives you leverage, you can buy more stock than your cash balance, and it lets you short, sell a stock you don't own, because the broker lends you the shares to sell. A cash account does neither. You can only buy what you've paid for. No leverage, no shorting. And, this is the important part, no PDT rule. The cash account is the simpler product. The margin account is the standard structure for day trading US equities because it's the only one that gives you intraday buying power above your cash balance. That's the trade-off you're signing up for when you tick the margin box. Now the PDT rule. The mechanics are clean. A day trade is the opening and closing of the same security in the same session in a margin account. Buy Nvidia at 10 a.m., sell it at 2 p.m. That's one day trade. Hold it overnight, not a day trade. Do 4 of those round trips inside 5 business days, and they make up more than 6% of your total trades, and your account gets flagged. Pattern day trader. From that moment on, you must hold at least $25,000 in equity at the start of any day you want to day trade. Drop below it, and the broker blocks further day trades until you top it back up. The flag itself stays for 60 to 90 days of no activity before most brokers will remove it. The $25,000 number was set in 2001 and has never been indexed to inflation. In 2026 dollars, that's a materially smaller bar than the rule makers had in mind. Doesn't matter. The number is what it is, and it only applies to US equities and single stock options inside a margin account. Futures, Forex, options on futures, totally outside the PDT framework. Cash accounts, also outside. Remember that. We'll come back to it. What you actually get in exchange for being PDT flagged is 4-to-1 intraday buying power. The math is 4 times your maintenance margin excess at yesterday's close. In plain English, $30,000 in equity gives you $120,000 of intraday firepower. $50,000 gives you $200,000. $100,000 gives you $400,000. That's the headline benefit. The catch, and this is where most newcomers get it wrong, is that the 4-to-1 only works intraday. The moment you carry a position past the closing bell, Regulation T kicks in and the leverage drops to 2-to-1. That's the structural reason day trading buying power exists in the first place. The broker is willing to lend you more when the position is guaranteed to flatten before the close. Risk on the broker's books is much lower on a position that won't exist tomorrow. Now the death spiral. Margin calls come in 2 flavors, and confusing them is how rookie traders blow up. A reg-t maintenance call is what happens when your existing positions lose enough that your equity falls below the broker's maintenance requirement, usually 30 to 40% of position value. You've got 2 to 5 business days to deposit cash where the broker liquidates positions of its choosing. That's the slow motion call. The day trading margin call is different. It's triggered when you exceed your 4-to-1 buying power ceiling. 5 business days to deposit the excess. Until you do, you're capped at 2-to-1. A second DT call inside 90 days, and most brokers restrict you to settled cash trading for 90 days. 3 or 4 of those, and margin privileges get pulled entirely. Each call is the broker tightening the leash. Here's the part that wrecks small accounts. 4-to-1 leverage is symmetric. A 1% adverse move on a fully margined position is 4% of account equity. 3 of those in a row puts a $30,000 account at $26,400. A 4th puts you under $25,000, and now the PDT flag is an active block on your recovery trades. You can't trade your way out. The leverage that was supposed to amplify gains accelerated the losses and locked the door behind you. That's the death spiral. It's the single biggest reason small day trading accounts go to zero. So what if you don't have $25,000? There are real workarounds, and they're not equal. The cash account is the cleanest. No PDT rule, but you can only trade settled cash, which caps how many round trips you can run per session. Futures sit in a different regulatory regime entirely. CME micros need $500 to $2,000 and have no PDT. Forex and CFDs run on spreads instead of commissions and start around $200, but they're a different instrument set. Prop firm evaluations let you trade firm capital after a one-time fee, with profit share and drawdown rules. Offshore brokers will give you margin without a PDT cap, and without the FINRA protection, which matters more than most retail traders realize. Pick the one that matches your strategy. Don't just pick the one with the lowest barrier. So the verdict: margin makes sense when you've already demonstrated positive expected value across hundreds of trades, when your account is comfortably above 25,000, when you flatten before the close so margin interest is zero, and when you have a written risk framework: 1% of equity per trade, 3% daily loss cap, hard stop, and walk away. Margin does not make sense when you're still learning a strategy, when you're using leverage to make a small account feel bigger, or when you're carrying losing positions overnight to avoid taking the loss. That 2001 $25,000 threshold I mentioned at the start, it's not arbitrary. It's the regulator's estimate of the capital you need to absorb the inevitable losing streak without going to zero. Inflation has eroded that number for 25 years, and it still catches people out. Treat it as the floor, not the goal. If you're under it and serious about day trading US equities, the cash account is the path. If you're over it, the 4-to-1 is a tool, not a shortcut.
Margin is a tool, not a shortcut. Full breakdown linked in the description.